Welcome back to another video. Got some updates on the portfolio. Still buying some stuff here and there, but yeah, this is the more passive income dividend portfolio I've been working on. I did actually a lot of buying in August, so we can kind of compare the previous month to this month. Now the date is September 1st. This probably won't go out, this video, for like a week or so, but so the snapshot that I took was from September 1st, although, August 31st was the Friday, so, and there was a holiday weekend, so technically September, the first day in September that people buy, sell stuff, was the third, third or fourth, one of those days. Anyway, this is just a snapshot from one of these days. So Snap-on, we added a little bit here. I think I only bought like a share or two. SCHD. I think we bought a share or two as well. Let's see from the previous month. Yeah, we had 20. We had 58 SCHD, so we bought two more. Nothing with the Exxon. I'm kind of annoyed too. I didn't color code it how I wanted to. I wanted to color code it green with the positive P&L, but kind of forgot. Intel still down a good amount, although Intel did have a little bit of a bump. I'm actually, I hate that I'm saying this, but the stock got cheap enough where it's like, or low enough where it's like, do I buy more and try to average down? Definitely a thought had dabbled in my mind, although I don't think it's already a huge percentage of the portfolio, and I've already dumped a lot of money into it, so I don't think that's the best idea, but I guess I should back up too. I bought more Snap-on because I just like the company. Fundamentally, it's great. It is expensive though, so I'm not very happy about buying at this price, but also I like the company, so it's okay. SHD, just kind of dribbling some money in here and there. Nothing with J&J, Verizon, Smith & Wesson, Simon Property. Although Simon Property did increase their dividend to $2.05. I think it was like $2. So a little bit of a bump there. Google, new position. I owned Google like $100, I think. Maybe a year ago, maybe 2 years at this point, I'm not sure. I ended up selling because I had a pretty big profit. I decided to get back in. Let's see, do I have? Yeah, but some notes over here. Like, the company is just solid. I mean, again, these are just snapshots in history about a metric, but the company itself is just too good. They make too much cash. They make a lot of free cash flow. They're in a still growing space. I think they can, like, just YouTube alone, I see so much more potential and earnings from that. So they can make so much more money there. And yeah, I think it's pretty, not obvious, but I think it's quite clear where the internet is going within the next decade or two. It's not really going away unless there's like some massive E2P or something, which is always possible, but I think the risk reward there is great. They did start paying a dividend, if they're not leveraged at all, which is really big. They did start paying a dividend too. It's only like 40 cents a share, so that, actually, what is it? The yield's like 0.5%, so pretty low. But what was I gonna say about that? Yeah, if we take if we take the average of the 3 years of the free cash flow and divide it by how much money they're paying out, it's like 15%. So even at that low of a multiple, sorry, what I meant to say, even at that low of a dividend payout, it's still like, I mean, 15%, it's low free cash flow to, like, dividend payout, but that yield is so low because the price is just so high. So something to take into consideration. So that they're paying a dividend, it's just really low because the company's so expensive, and yeah, obviously they're going to probably increase it over time, but they're probably, it's not going to be that high just because, or the dividend yield itself won't be that high just because the stock price is also so high. But yeah, I wanted to add this back in the portfolio because I just want good companies that don't have a lot of debt, and Google fits that. So it did drop in price this week, so today's like the 5th or 6th of September. It did drop, so I'm gonna be eyeing it up and probably buying a few more shares. So nothing with Ruger, Qualcomm. I decided to buy as like a little, I would say trade, but you know, the semiconductor space had a big pullback, and kind of wanted to hop in on I wanted to hop in on that opportunity of the pullback in anticipation that it might go back up. I think, you know, I like, out of AMD and Nvidia, Qualcomm, Intel, MU, I think Qualcomm, in my opinion, is the second. Actually, no, I mean, obviously Nvidia's the best, but that's just because also it's getting the most hype. But Qualcomm, I think, is a good competitor, although if we're getting really into the semiconductor space, Nvidia and Qualcomm are different sub-niches of that. But anyway, I bought it mostly from a technical perspective because there's a massive, relatively large pullback, a rapid pullback in the semiconductor space, and just threw some money at it. Pan American Silver, PAS, I had this in the portfolio a couple years ago. A really good gold and silver, I think it's a royalty company if I'm not mistaken. Decided to add it back because gold is like all-time highs. It's pretty high. I think it was definitely above 2K. Silver price is still like below 30, but the valuation of Pan American Silver relative to the gold and silver price, I don't think is very reflective of what it should be. So I think Pan American is slightly undervalued, or I think just several gold and silver miners are undervalued. So hopping in a little bit here, I'm not a huge fan of the gold and silver space anymore, just because I had a lot of dead money in it for a while. But you know, I did make some money too. Like, I think in general, I made a good amount of money in the gold and silver space relative to, again, my portfolio and how much money I was putting in it at the time. But I just see a little bit of an opportunity here, so just to put some money in one of the better gold and silver stocks out there, or companies out there. UPS, I didn't do any adding. Merck didn't do anything. Hasbro and VMY didn't do anything either. I did do, I'll go through it in a minute, but I did do some brief analysis of UPS, Merck, and J&J. I wasn't too happy with it, but I will talk about that in a minute. So we're looking at a portfolio yield of about 3.4%, almost $100 yearly payout. My portfolio gain relative to how much money I put into it is about 26.5%. Cash, we're looking at about 13%. Dividend stocks about 68%. ETFs about 15%, and trades about, I think, 3%. And this is only the cash within the stock account, so we got the high yield savings and some bonds as well. Qualcomm, added some new positions, added some more money. I did end up selling Bristol Myers. I had like a 2.5% gain. I think we went through one dividend period. I sold it because I don't even know why I had it. So I think if you ask yourself that question, I just got out. Like I didn't see any value in the portfolio, and it was a really small position too. So you discussed Pan American, valuation seems low. Google, it's too solid of a company to not own. It's expensive, but yeah, Qualcomm, we discussed pullback in the semiconductor space. Intel's, it really stinks to be in in the semiconductor space because the last couple of years it's been moving like up a lot with like all the stocks, and I'm owning the one stock or one of them within that space that got clobbered, and it's just like wow, like it's not a very feels good kind of thing. Even if Intel's a good company, again that's an opinion. And I guess it doesn't matter, but the market doesn't see it that way. So yeah, it just gets destroyed. It could have made more money or unrealized gains in other semiconductor stocks. But I would have taken those profits by now. What if I owned like AMD or Nvidia and it went up like 20-30%? Yeah, I would probably take that profit. So anyway, I wouldn't have rode the whole wave anyway. I did add a lot more to the savings account. Again, just this high yield savings is like over 4%. It's like, why not, you know? So, those are some of the new updates. Let's see. Yeah. So I did some brief number crunching. The last like 4 years for J&J, Merck, and UPS. These are the metrics that I judged that I think are the most valuable. And again, these aren't representative of the entire company, but these are like, to me, highlights and data points where they're important enough and tell me enough about the company if I want to, keep buying more, or if I should hold off, or, something like that. Or I guess do more research. So we got the year end, the last 4 years. We have free cash flow per share, free cash flow growth, the 3-year average, free cash flow payout ratio. Sorry, my handwriting's a little bad. Working capital to debt, and debt to equity. And these debt to equities include goodwill and intangibles. I'm not like the biggest fan of that. But companies like J&J, and they just kind of needed to add that because they own a lot of like patents and stuff, which is, it's not physical, so it makes sense. It's just, but yeah, if you don't include the intangibles, their debt to equity is like a 1,000,000% or something like that, which is higher debt to equity bad. So free cash flow per share, we want really high. We want good, positive free cash flow growth. Working capital to average free cash, we want that to be low. Typically, like, below 70%, but again, depends on the company. And working capital to debt, I want that to be high. I want above 1. Debt to equity, you want below 1 or 100%. So, we'll do J&J first. Free cash flow per share relatively decreased over time. Sorry, my handwriting's bad. I tried to make this neat, but 2020, 2021, 2022, 2023. So free cash flow per share is not really doing too much. Free cash flow growth, I mean, if anything, they kind of decreased. Their free cash flow payout ratio is kind of consistent. These last 2 years are skewed, 2020, 2021 are skewed by 2019. All the stuff that was going on with COVID. Working capital debt is awful, so current assets minus current liabilities divided by the debt, pretty bad. And debt to equity, it seems good, but again, a lot of intangibles. MRK, free cash flow per share, very low free cash flow per share, not really generating a whole lot. And again, it's a free cash flow divided by the total shares outstanding. So judging by these two companies, just on free cash flow per share, it's like, why would I buy MRK when I could buy J&J just earning more free cash flow per share? But anyway, the growth's kind of all over the place here. The free cash flow, the payout ratios, and then about like 60-70%. I mean, it was really high in these 2 years, but we got to take that into consideration with when it was. Very bad at working capital debt, and debt to equity is also pretty meh. UPS free cash flow per share was really high 2021, 2022, but kind of back to where it was in 2020. Free cash flow growth, not really too consistent. Payout ratio, we're looking at it in like the 60s. Very low working capital debt, so they're pretty leveraged, and over 100% debt to equity, including tangibles and goodwill and stuff like that, so not the best. So now, valuation, I did this on August 23rd. I took the market cap divided by the 3-year average free cash flow. Looking at 21 points, the lower this number, the better value of a company. This is basically the PE, but I wanted to use free cash flow. 21.7 for J&J, MRK 26.5, and UPS is 13. So out of the value here, on the last 3 years of the free cash flow relative to the current market cap on August 23, UPS is the best value. Relatively, I think all these companies, in my opinion, have somewhat weak free cash flow growth. Or not really consistent, it's hard to gauge, but they're all very leveraged, and that I don't like. So I can kind of relate them or compare them all in the same sense as these are leveraged companies that pay a dividend, and this is their valuation. So after doing this, I don't really want to buy any of these companies any further. I did buy a lot of not a lot, but we did buy J&J, I think 2 months ago. A lot of it, not a lot of it, but again, like 14 shares. So it's like almost 9% of the portfolio right now. I think I should not add any more to that. It just seemed like a value. Again, the company could be good and, it could grow and stuff, but it's leveraged, and I don't like that. Too leveraged in this sense. And it's expensive. 21.7. Again, this number was all relative to, and these numbers are quite comparable because it's the same sector, but UPS is a completely different sector. But at the end of the day, I can make the argument, if you have 10 companies and you understand their leverage, how much they're leveraged, like with their debt, how much money they're generating from free cash flow, and you can somewhat have a sense of how consistent or how much growth in the free cash flow is expected from the companies. If you compare all those 3 metrics, it doesn't matter which sector you're in. I'm trying to say that that is comparable regardless of the sector. Maybe that's an opinion and people could debate that, but I think it makes sense. The hardest one to predict is how much free cash flow they can be making in the future. Is it sustainable and consistent? Because that's ultimately going to be dependent on the valuation and what the market values it at. So I don't really think I did too much else. Yeah. But yeah, for next month, for this month, September, probably gonna be adding some Google. We'll see how the Qualcomm and Pan American silver stuff do. I gotta check when they have earnings, regardless of if I have a profit or loss. I'm probably gonna get out before earnings because I don't want to play that game. Hasbro, debating just selling the 2 shares because it's like I'm up 45%. I don't know if I need it. I do probably want to add either VMY. I would like to have some other ETF, not just SCHD. Just some different stocks and strategy between these 2 ETFs. Still, Kruger. Yeah, Kruger and Smith & Wesson. I still would like to sell like one of those. But yeah, I'm not really looking to add UPS or MRK. Yeah, it's hard to find these companies that I want. There's not a billion of them. But anyway, that's all I really have today for these updates. If if you enjoyed the video though, let me know. I'm trying out a different mic in this video. I did try last episode to do like a normal talking, but I don't think anyone really liked it, so which is okay. I mean, this is the content that the whispering with the stocks is what you guys enjoy, from my understanding, not me talking. So, but it doesn't hurt to try some things every now and then. Anyway, though,